Hi everyone, I'm Jim Pilot with Peak Wealth Management. And today we're going to talk about a case study. So I had the opportunity to speak in front of a group of professionals the other day. This case study came about and we thought we would use it as a way to illustrate our financial planning software. So here's a hypothetical client that we've used for other things, what we call the Mr. and Mrs. Schoolcraft. So if we look at the quick overview of their situation, we see that they have a net worth of $850,000 and their investment portfolio is $650,000. So we know that they have accumulated some assets at this point. We'll look at some of the general facts about them. Both are age 56 at this point, want to retire at age 65, and we give them a life expectancy of age 90. We can look at their income and see that both Mr. and Mrs. Schoolcraft are both making $100,000 a year, and we'll do that up until their retirement date of age 65, and then we see Social Security come into the picture as an income stream. So they will be able to then transition from living off of their employment income to their Social Security income. Their net worth, we show some different investment accounts for them. They have a joint brokerage account with $200,000 in it. Each of them has a 401k. Each of them has a Roth IRA. We have the value of their house at $400,000, and then the mortgage balance is $200,000. So that's where we come up with the numbers as far as their net worth and their assets. Current savings, we show that each Mr. and Mrs. Schoolcraft are doing 10% of their income into their 401ks, and the employer is contributing a 3% match on that. So typical for what we see, but it's a decent savings rate at 10%. It's a rule of thumb is that we want to be in that neighborhood of 10 to 15% of our income over our working careers. We show their current expenses they live off $100,000 a year, but we don't want to show them in retirement having a setback or a different lifestyle. So we don't want them to retire to a lesser lifestyle. So we also show the same $100,000 a year as their need is in retirement. So that sets up their basic situation, but so we'll take a look over here to see how does it look? How are Mr. and Mrs. Schoolcraft doing with all the money that they have saved so far? So we can see from this chart, you can see that at age 56 now, all the way to age 65 is a retirement, and we can see that each year it goes up, right? We're growing that by their savings that they're contributing to the 401ks. We're growing that by the employer match. We're growing that by just rate of return. We like to be conservative in our assumptions, so we show it growing at a little over 5% rate of return. So we show that all the way up until age 65 is where we get the high point for them. But then they have that same $100,000 a year that they want to spend. But if you remember, Social Security is only going to offset $27,000, $28,000 for each individual. So by the time they reach age 83, we show that the portfolio is depleted and there's no more assets left. So we need to help Mr. and Mrs. Schoolcraft figure out what they can do different, right? They really have three choices. They can either work longer, they can save more, or they can spend less. So through this illustration, we'll be able to see the impact of those things. So we know that they're making a good income. If they're making $200,000, even if we take out some the savings and the taxes and all those different things, they're only spending $100,000, so there's a gap there. So what if instead of just blowing it all, we can convince them to do some additional savings? So we flip the switch here and you'll see the blue is the plan we were on. The green shows the change that we made by them just doing an extra $10,000 a year. So we have them saving additionally each month to the tune of $10,000 a year, and that has improved their situation by 2 years. So they have an additional 2 years of funding, totaling almost $300,000 just by saving that $10,000 a year for 9 years. So that's a powerful thing that they can do. The other thing they could do is they could work longer. So if we have them work until age 67 instead of 65, you can see the impact that has. So now we have them all the way out here at age 90 with assets left, right? And you think, at first glance, you think that's great. They have money left. That's all they need to do is work a couple extra years, right? Because we know that working extra years has the impact of delaying how soon they need to take money out of the retirement accounts. It allows the accounts to grow that many more years, allows them to live off their income for more years. So it has a multi benefit for them to continue doing that. But one thing I'll show real quick is a Monte Carlo simulation. So what this does is this will show, well, what is their probability of success, right? Remember when we showed them working longer, at age 90 it showed that they had money left. But a Monte Carlo will run the simulation 1,000 different ways. So we see, well, what happens if we get good return years early in retirement versus what happens if we get bad return years early in retirement. And if we vary those rates of return, you can see just by them working a little longer only gives it a 69% probability of success. And that's not good enough. We want it to see that at 100%. So we go back and we tweak some more and say, well, what happens if we can convince them just to spend less? You know, we talk a lot about expense tracking, and what if through that expense tracking process they realize that maybe they don't need to live off $100,000 a year, but we can get by off of $90,000 a year. So that, just doing that adjustment on how much they're spending, you can see we've gained 5 years and $583,000 in value gained. So again, that's a pretty powerful, if you look at it just being that $10,000 a year. But again, we haven't made it to age 90. So what happens if we do a combination of these and we say, we can reduce expenses some, we can work a little bit longer, and we can save more. Now we have the shape of the chart that we like to see, right? You can see that it does still slope down a little, which we tend to see later in retirement when we bring the RMDs into play and inflation starts to take over, because we know that the inflation rate on Social Security hasn't typically kept up with what we see actual inflation be. So it's not uncommon to see that. But we have a shape that we feel much more confident about, that we like a lot more. Now here we have them, you know, at age 90 with that 1.5 million in surplus, because before we were at a deficit of almost $1 million. So it's a huge swing, and it really puts them in a much better situation. If we then toggle over to the Monte Carlo one more time to say, what is our probability of success? This is a much more what we're looking for. We want to see a really high probability of success. It probably is actually 100% due to a rounding error, maybe not quite all the way there, but even in the worst 2.5% of scenarios, they still have 146,000 left at the end of that. So this has just been a quick way to go through and kind of describe and show you how our planning software works. It's a good opportunity to put yourself in Mr. and Mrs. Schoolcraft's shoes and to say, am I on track? Am I doing the right things? And if I'm not, what do I need to toggle, right? What can I do to change my situation so that I can get to retirement with that really high probability of success, knowing that I can retire with confidence? So if you have a portfolio that you want a second opinion on, if you have a financial plan that you want, or if you don't have a financial plan, or if you want a second opinion on either of those, and you have a portfolio of $500,000 or more, visit our website. peakwm.com is a great place to start. From the website, you can learn more about us. You can see some of our podcasts. It's a great way to get to know us. You can even schedule right online there. But we're always available by phone or email as well, and we'd be happy to talk to you.